Welcome back, everybody. It's good to have you to another market update for the Greater Milwaukee Area, this time January 2023. Still not used to it, but I said it correctly. I have some interesting data for you today. First of all, we're going to take a recap of last year, 2022. It's always good to look at year-over-year data. That gives you a big picture. When you look at month-over-month, there's a lot of noise in there. Real estate is kind of slower moving, so you want to pay attention to these major trends, and year-over-year data is usually better for that. So then we're going to take a look at what's going on currently with the market. And if you are watching the news and you hear about the economy and recession and inflation and price reductions in the real estate market, you might get the idea that this is also happening in the Milwaukee market. You'll be surprised. I'll have the actual data. I'll show you what people are currently paying for houses that are on the market, how much over or under list price they are paying, and what's currently really happening with prices. I got the data here for you. And then we're going to take a look what might happen in the next 2 or 3 months. What can we expect from this year's spring market? We have some early indications. Before we get into that, let's get started with the latest data from the local MLS, December 2022. We have seen inventory go up a little bit compared to 2021, which was a complete outlier year in the wake of COVID. But when you look at 2,800 units, that's really nothing. December 2015, we had over 10,000 units. That's kind of a normal inventory we would expect. That gives you a sense for how tight inventory really is. In terms of sales, 1,681 homes sold. That is minus 35% almost. If you have been following my market updates, that's no news for you. It follows in line with the trend that we have seen in October and November. The marketplace entirely is compressing, not only on the buyer side because of mortgage rates, but also on the seller side, because a lot of sellers are looking at buying a more expensive home at a much higher mortgage rates, which really means a lot higher payment, and that makes them hesitate, and they're kind of clinging on to their house with a 3% mortgage rate that they might have. So that's the reason why we're seeing fewer new listings coming on the market. And that doesn't really help if you are on the buying side. So the marketplace overall is seeing a dramatic compression. Minus 35% is kind of what we have seen here over the last few months. In terms of velocity, 16 days on market was the median. That is a lot slower than what we have seen last year in spring and summer, but it is still extremely fast-paced. 68 days was it back in December of 2015. That's kind of what we all remember. It takes a few months to sell a house, right? So, selling it on the first or on the second weekend is really the sign of a very fast market. In terms of pricing, we finished the year with a median price of $270,000, still up 6.72% over last year, December. And overall, the marketplace in December has felt very, very hot. This is not normally what we would expect from a December, and we are still remaining in a seller's market. So that stands a little bit in a contrast of what you might be hearing in the news, and I'll get back to that and explain why this is happening in just a little bit here. Let's take a look at inventory quickly. So this chart shows you the number of new listings that are coming on the Milwaukee market every month, and we're getting back to kind of a more normal seasonality after the COVID years, so it makes things a little bit more easier to anticipate, more predictable, I should say. And new inventory was very low. You see here a little less than 1,000 units that came on the market, so not too much to choose from. And that is even less than what we have seen last year in December. That was about 1,200, a little over 1,200 units. And those are very low numbers. I mean, granted, December is always like this. So what can we expect from the next month, January and February? You can see here, we should normally expect that number to almost double, about 2,000 units coming on the market in the Milwaukee area here in January and February. And then March is usually when things really get started. So as a seller, if you want to time it, it actually pays to take a head start, because if you bring your house on the market earlier, you are still doing that without much other seller competition. So the longer you wait in spring, the more your listing will have to compete with other listings that are coming on the market as well. May and June are usually the peak when most new houses are coming on the market. All right, what's going on with prices? So If you want to keep a number in mind, if somebody's asking you, so how much did real estate prices go up at the end of the day in Milwaukee last year, then think 7%. There's two ways of looking at it, and there are two different numbers. You can see here 6.72% and 8.81. I'll explain quickly what the difference is, because the 6.72 is December versus December, so that's actually month over month. There is an argument for comparing it this way. You can see that also on the little chart I have here on the left side. So that is the December versus December comparison. And that is important to compare it this way because we have a very strong seasonality in the prices in the Milwaukee market. So that is important to keep that in mind. But another good way of comparing it is really a full year comparison. And that comes back with 8.81% price increase. So both ways are good ways of looking at it. But I would say, take something in the middle. About 7% is what we have seen prices going up, which coincidentally lines kind of up with the inflation number that we have seen overall. So it's kind of in the same magnitude with how much the dollar has devaluated. Our home prices have made up for just around about that. The only way that I'm not really in favor of looking at real estate prices is to compare it 1 month versus the next, because we have such a strong seasonality. To say that prices in December were significantly lower than in June or July, and therefore the market is coming down, that is really not a good argument, because you can see based on the seasonality that is happening every single year. So you can either compare a year with a year or a month with a month. That gives you a better number. All right. So what's happening with the overall market? I already mentioned the marketplace is compressing. A lot of that has been happening in the second half of the year. And we have finished the year here, Greater Milwaukee Area, with a little over 14,000 single-family homes sold. That compares, quite a bit less, 19% less to the year before, 17,500 here. So the overall marketplace is shrinking, but the question is, what does that mean? Is that a lot or not? So I have here the 2015 number, and so about 15,000 is kind of a normal number here. And this number is, I want you to keep that in mind, because that is significant to really understand why we have such a strong housing demand in the Milwaukee area. And therefore, I need to walk you through demographics real quick. You may have heard this before, that the demand overall that we're seeing in the US in the real estate market is because of a shift in demographic. Millennials are aging into the home buying years. They're tired of renting. They want to buy a home. So what does that mean for Milwaukee? We have in the metro area about 1.6 million people. About 600,000 people live in the city of Milwaukee. And we have 19 other municipalities in Milwaukee County and the surrounding counties. So if you tally all up, it's about 1.6 million people. And here you have the breakdown by generation. So first of all, we have here the Gen Z, so that's basically everybody who was born after 2000. So they're just basically getting in or out of college, and a lot of them are still living at home, so they're not really participating in the home market. Then we have the largest group at the moment, which is millennials, about 352,000 millennials. Then Gen X, which is my generation, about 320,000, and the boomers, almost 350,000, and then people that are called pre-boomers, so they're older. So now when you look at the millennials, and the significance is here that for many years it has been said that millennials are not home buyers. They're different. They take an Uber and they're going to rent their home. They're not going to own a home. That was true for a certain period of time, but now the oldest millennials are getting 39, 40 years old. They're getting married, having family, having kids. So they are getting to the point where they really are tired of renting and they want to buy a home for their family. And that generational shift is really what's driving the housing market, because for so long millennials have held back and they kind of fooled the industry into, hey, we're renting, and then relatively quickly within 2 or 3 years a lot of them changed their mindset. No, never mind, we're actually going to buy a house. So this is where a lot of the demand is coming from. And for the Milwaukee area, that means a lot of them are buying houses under $350,000. And when you compare 352,000 millennials, that is in the Milwaukee area, with the numbers that you've just seen, about 15,000 houses, single families sold in a year, you can see how many people are actually competing for a relatively limited number of houses. It's not that all millennials want to buy a house at the same time, of course, but you can still see there is a massive wave of demand that is not going to subside anytime soon, because once these guys are done buying houses, then the Gen Z will be old enough that they're looking on buying houses as well. Gen X is usually upgrading, so they're buying typically homes over $350,000. And then you have the boomers, and a lot of boomers are actually aging in place, so they are downgrading. We have about 348,000 boomers. So bottom line, demographic demand was a huge driver for the market in the last years, and it will remain to be for years to come, because that is simply something that does not change overnight. But we have not only had upward pressure on the market, we also had some factors cooling down the market and suppressing it. And the biggest one was, of course, inflation. I've spoken on this channel extensively about the impact of inflation. In a nutshell, the impact is in a couple of different ways. The first is that consumers have less money in their pocket. If they spend more on groceries and gasoline, they have less money for down payment and for mortgage payments. But there's also a huge psychological impact, because you don't know how bad it is going to get. So human nature is to just hunker down with whatever you have right now and not make any sudden moves or changes. And so there's a psychological effect why people have stopped buying houses for that reason. But it also drives the Federal Reserve's policy, which drives the fund rate. And there is an indirect impact also on mortgage rates. And when mortgage rates are going up a lot, it makes buying a house a lot more expensive and really suppresses the housing market. And we've never had a year where the mortgage interest rate has doubled in one single year. So we went from a little over 3% in January to over 6% by the end of the year. And at the peak, we were over 7%. So the market was just completely sticker shocked. And a lot of people stepped on the sidelines and said, you know what, I really want to buy a house, but not right now. We have to wait until rates are coming down. And that's what they have done. Now, where the mortgage rates coming from, and this is important to understand because that's going to be a big factor in 2023. I've spoken a little bit more about this in the December market update. Just a quick refresher. We have an average spread of the 30-year fixed mortgage rate over the 10-year treasury yield. So over the last 50 years, it was always around 1.7. And at the moment, we have a much larger spread between the T-bond and the mortgage rates, because banks are factoring that in for risk. There was a lot of economic uncertainty, and that's the reason why over the course of the last year, we really have seen that spread go up from the 50-year average down here to all the way over 3. So the banks are charging a premium on mortgage rates currently to factor in for that. And we have seen that kind of steadily go up in the first half of the year. And then in August, the Fed has announced that they really have to take stronger measures against inflation. Remember, that is when we hit peak inflation. Jerome Powell says we also have to reset the housing market. And then the banks responded to that with an even stronger increase in mortgage rates, and that gap really spread a lot more. But there is that average normal gap of about 1.7, and as we're getting more certainty about what's going on with the economy, we have seen that extra margin that the banks are putting in, we are seeing that coming down. But we still have about a 1% difference, and right now we're in the middle 6% mortgage rate. So if that would come down to a historic norm, we should be seeing rates in the mid fives, about 5.5. And this is the logic why a lot of mortgage experts are predicting that rates are going to come down in the next 12 months. Nobody knows for sure, but they're making actually a really good case. And that's the reason why a lot of buyers currently are buying not with 30-year fixed, but with 5-year adjustable rate mortgages, because they are taking that bet that in the next 5 years, at some point, they are going to refinance at a lower rate. So with mortgage rates in the 6 and 7% range, you would expect that home prices are coming down. So that's the reason why over the last month, I've been carefully watching the MLS to see how much people were paying over or under asking price compared to the list price of the seller. And I pulled down all the data and put it on a chart here. And what you can see here is, here's kind of the zero line. You can see here from $250,000 houses to 500 to all the way up to $1 million, how much people have paid over, which is in the green area here, or how much of a discount they were able to negotiate, which is in the red area. And the bottom line is, that we have seen about 57% of deals go through with either selling at list price or selling over list price. Only 43% of them have been able to negotiate a discount. And considering the seasonality and the time of the year, November and December, we really would have expected more discounting here going on in the marketplace than we've actually have seen. You can see here a lot of people were paying up to $20,000 over list price. And then this is kind of the $40,000 line, which is kind of where it cuts off. Actually, 50, you see a few dots here over, and then you have some outliers all the way up to 100,000. So relatively speaking, the market has held up stronger in November and December as we would have anticipated it. And I can tell you the first few days in January have been very, very competitive. I've been involved in a number of deals already, and every single one was multiple offers and ended up going way over asking price. So for me, this is kind of a deja vu. January this year actually starts to feel very much like January did last year. And an important note here to interest rates: if rates are actually dropping to below 6%, which is kind of seems like the boundary line for a lot of people that are on the sidelines currently, where they want to jump back in below 6%, then the level of competition is going to increase significantly here in the Milwaukee market. So let's take a look at what home prices are expected to be on a national level for 2023. You can see we're all over the map. So experts have no consensus at the moment where the national real estate market is going. You see here the most optimistic ones, over 5% plus. The most pessimistic ones, Ivy Zellman, with minus 5%. She's thinking that the market is really coming down in price. The reason that is it depends on which geographic area you're looking at. Last year, we had pretty good consensus. If you look at my market update from 12 months ago, I had the same chart here. Everybody was anticipating 6-7% in the plus. It turns out that most of them were too conservative with that, but now we're all over the board. And the reason is that home prices are so different across the country. And I want to give you a little bit of a taste of what that looks like. So this chart here shows the median home price on a national level. That is the red line, and you can also see median home prices in Milwaukee, including the seasonality. First thing you might see here is that the seasonality in Milwaukee is more pronounced than it is on average on a national level. Here, that's the red line. And the second thing you see here is that the national prices kind of followed that line until in 2020, it really started abandoning, and they started, going up here much, much faster than they have been in normal years previously. Milwaukee prices have kind of been following that normal trend. So not only we are much below what the national average is, so Milwaukee houses, for us, it feels too expensive, but on a national average, Milwaukee housing is still very, very cheap. This is also the reason, affordable, I should say. This is also the reason why a lot of people are moving to the Milwaukee area, because they can work remotely and it doesn't really matter. Now, here are some metro areas, and when researchers and analysts are talking about markets, real estate markets are going to correct. Prices are going to come down. Redfin, for example, is expecting a 4 to 6% reduction in home prices in next year. The reason is because a lot of these markets that factor into that national average are much, much higher in pricing than we are in Milwaukee. So you have the light blue line here in Milwaukee, and then you got Phoenix here. You have Austin, you have Denver, you have Boston, Seattle here is in the top. I did not put San Francisco on here because that would be somewhere up here and you wouldn't be able to see the rest of it. So a lot of these markets have seen an exuberance that we have not seen in Milwaukee. And that's the reason why we have a little different situation going on in Milwaukee than we have in the rest of the country. So Redfin comes to the conclusion when they look at their 2023 predictions that, and this was a little bit of a surprise to me, that Milwaukee is going to be in the top 3 of the most competitive markets in 2023. And they come to that conclusion by following that data in the months leading up to 2023. They've been looking at demand, they've been looking at supply, and then they're ranking all the metro areas, and Milwaukee is in the top 3. So last year we were in the top 10 most competitive metro areas in the country. This year, apparently, it looks like we are going to ranking even higher. A little bit of a surprise to me is also Lake County and Chicago in Illinois, because those are markets that have not done so well. A lot of people are moving out of Illinois, a lot of people are moving out of Chicago, but the real estate market has been holding up very strong there as well. So brace for competition in 2023. What are some of the expectations for the next month? So first of all, January has already seen a lot of bidding wars, and that is given me an early feel of what's going on. It's before Christmas. I'm always a little bit uncertain what to expect from January, but in what I've seen in the last couple of weeks in the marketplace and also talking to other agents, it feels very, very much reminiscent of January 2022, and the spring that followed that market last year was absolutely crazy in terms of competition. So Milwaukee home prices will continue to rise, probably a little bit more moderately than what we have seen in previous years. It's going to depend a lot on what mortgage rates are doing. So that is kind of turning on and off the faucet a little bit more in terms of competitiveness. But from everything that we see here, Milwaukee home prices should continue to go up. And that is against the trend that we see on a national level. Inventory will hopefully rise in spring. We're expecting more listings coming in February and in March, but I think it's going to be slimmer pickings than we've seen in previous years. And that means it's going to be a very tough market. So we're already seeing it. A lot of agents are leaving the industry because it's a very technical, a very skill-based market. And for a lot of agents, that just has not been very good to them. Buyers will need to be very patient and also prepared. So we focus a lot on getting buyers educated and getting good information in front of our clients so they can make good decisions and so they're prepared competing successfully in this very difficult market. So overall, based on the data that we have today, it looks like we're going to remain in a seller's market this year. The level of competitiveness will very much remain on what mortgage rates are going to do over the next few months. So if you have any real estate plans for 2023, if you're contemplating a move and you're not sure what to make out of this and what your personal strategy should look like, or if you have concerns or questions, reach out to me. I'm always happy to hear from you. You have my phone number and my email address here on the screen. And you can also go to my website, onpointrg.com, and you have access there directly to my calendar. So if you click on this button here, you can see what my schedule looks like, and you can book a phone call with me. You can book a Zoom call with me, depending on what you want to do. Just pick a time that's convenient for you. And I'm looking forward on speaking with you personally about your plans for 2023. That's pretty much all I got for you today. Thank you very much for watching. I'll see you next time.